Thanks very much for joining us. Let me first ask you, there's a populist concern, I would think, about giving the executive board bonuses in a year when you're posting a net loss of more than 5 billion euros. How do you justify that to, build Zeitung?
Well, so you read the papers in Germany, Matt, and we're obviously very alive to the considerations in our home market on these topics. Look, compensation overall is one of the most important management processes that we run every year. That's for the whole company and also for the management board. We gave deep consideration to our own decisions personally and as a group, and feel we arrived at the right compromise, if you like, between recognizing the costs both for shareholders and employees of the significant restructuring that we're undertaking and that we're leading for the company, but also attempting to align our interests with the long-term interests of shareholders. We think we struck the right balance both in the social environment and as responsible stewards of the company.
So walk me through how you get to this loss. 5.3 billion was the net number. I noticed pre-tax you lost 2.6 billion euros, but includes 3 billion in essentially restructuring costs.
Exactly. So our commentary is that really the loss this year, both after tax and pre-tax, was entirely driven by restructuring costs, transformation effects as we call them. And that's across a range of areas: deferred tax asset valuation adjustments, after tax, and then on the pre-tax line, goodwill impairments, software impairments, restructuring charges. That is all more or less in line with what we guided the market back in July when we announced this restructuring. We announced that we wanted to finance it from our own resources, and we've demonstrated in the first 2 quarters of this restructuring that we were able to do that. We, in fact, increased our capital ratio to 13.6%. So I see all of this is very much on track against the goals and targets that we set out. We've hit every single target, every single milestone of this restructuring. What I think is important is the message that the underlying business performance, once you strip out all of that noise that's created by the restructuring, is actually quite positive, showing stability in revenues, growth in pre-tax profit in the core bank. So we're very pleased with that result in the second half of 2019.
Are you on track or are you ahead of schedule here? Because 13.6% CET1 ratio, I notice you're getting a lot of the headcount reduction out of the way sooner than you may have planned. Does that provide a lot of upside for 2020?
Well, look, we're on track in every single metric or ahead. And where I'd say we're ahead is on the capital side. Also the deleveraging in the capital release unit. As you say, the personnel reductions have been moving apace. And with this step off into 2020, that underscores the confidence that we've been communicating to the market in the progress that we're making in this restructuring, in the decisions that we made strategically to realign, repoint the business, but also in the confidence that we think we've brought back to the company with our employees, with our clients in the capital markets. We see that in both the securities and markets, but in our everyday business and our engagement with our frontline, client officers.
What are you hearing from investors? Because we do see that confidence reflected in the share price. It's getting back to 8 right now. Can you give assurances that you're not going to need to go back for another capital raise?
So again, the first thing is the commitment to finance the restructuring from our capital resources, and we've now demonstrated a clear path to do that. We also demonstrated back on December 10th to investors the forward on our capital plan, which includes regulatory inflation and other things. So we feel very good and very confident about that. We feel good about hitting milestones and managing with discipline this execution. And we intend to absolutely continue that process. We are really an execution-focused management team. It's something that we had to demonstrate and I think had to regain credibility in the markets around. And I think you are seeing that in our securities prices.
Speaking of securities, you restructured that unit, and a lot of people feared that would kind of throw a spanner into the works of the whole investment bank. I see that revenue actually rose there. I think 5%. FICC trading was very positive. How does it look like it's performing in this quarter?
So if I look at the fourth quarter, absolutely we participated in the general uplift and relatively good market conditions in the fourth quarter. We were pleased at that time to see the momentum because it was especially important to demonstrate that the franchise was intact and positioned to at least stabilize revenues and grow on a go-forward basis. We think we've carried some of that momentum into 2020. And the market conditions, generally speaking, have continued that favorable trend. We're cautious about predicting a quarter when you're a month in, but we are gratified to see that the markets and our businesses carried the momentum into 2020.
We have seen yields come down on concern about the economy. What do the external factors look like to you in this quarter?
Well, look, the environment, I would say, has improved relative to the market's expectations, implied forward rates and what have you last year. Also, the assumptions, if you like, on which we built our plan. So we feel good, again, going into 2020, that we have a reasonably conservative outlook built into how we're running the business. I do think, and our economists are also of the view that the German economy, the global economy, gained momentum in the late part of 2019. We see that continuing into 2020 and 2021 in terms of sort of global economic growth. And also a recovery of, if you like, stability and perhaps a little bit of momentum in Germany as the world has worked through its trade issues, the auto industry issues, and what have you. So we have a cautiously optimistic outlook.
There's issues with trade. Obviously, the U.S.-China issue could turn into a U.S.-Europe issue. Do you see any signs of concern there?
Well, I think it's important that there's a dialogue between the sides. And as far as I can tell, there is a dialogue going on and a recognition that the trade relationships between, call it, the three major blocks of the world are changing in their dynamic somewhat. So as an optimist by nature, I would hope that dialogue between the U.S. and Europe trends in a fruitful direction going forward. I think it would be good for the economy. It would be good for workers on both sides of the Atlantic. And I'd certainly hope that that's the direction it takes.
It's probably more important for Germany than other countries because of the reliance on manufacturing. Have you seen them girding for uncertainty there? Is there relief about a relaxing of the uncertainty in the Brexit situation?
I'd say that, two things. In my conversations with CEOs in Germany, they're acutely aware of the trade environment and their relationships with two of the three largest trading partners for Germany, China, and the United States. So that awareness is certainly there. I'd say it's early, if you like, in terms of the sentiment to let down the guards. One has to be quite vigilant in managing our businesses and our clients' businesses. As it relates to Brexit and the EU, I think there's still, as we all know, considerable work to get done to establish that post-Brexit trade relationship. It does remain a risk, if you like, an overhang for the European economy, for the German economy. Again, one would hope that those discussions, trend in a positive, constructive way, because there is a fair amount at stake in terms of the economies of Europe and how that relationship is resolved.
An issue for the private bank has to be the negative rate situation, which doesn't look like it's going to change. How are clients dealing with that? How are you dealing with that?
So look, it's yes, our view is that the rate environment is likely to be stable in Europe for the foreseeable future, in part because the ECB will go through a strategic review that Madame Lagarde has announced. We see that, generally speaking, as an environment that is certainly better than additional rate declines. As it relates to our business and dialogue with clients, of course, we in the industry are now adjusting to a sense that this rate environment will persist for much longer than anyone had previously thought. So those dialogues are ongoing. We absolutely have to find ways to make our balance sheet more efficient, to sort of cease the practice of absorbing the impact of negative rates on behalf of our clients. That's mostly focused in the corporate business, where we've had very constructive dialogues with clients on how to manage their businesses, how to manage their use of our balance sheet in a more efficient, effective way to create something of a win-win out of our relationships with our client. That dialogue's been very constructive. On the retail side, it's mostly in a sort of a wealth management area that we would be having that dialogue. And again, I would say there it's a constructive dialogue because what we're trying to do is help our clients protect their wealth. And in today's world, if you're invested in deposits, over time that is going to be wealth destructive. So that's actually, generally speaking, a good dialogue. And when I speak to, also in the retail business, my colleagues in the front office in branches around the country, they're having that dialogue with our clients in Germany.
It's a heck of a time to extend your contract. You've just done that for another 3 years. When do you expect to be able to post a profit? When do you see the light at the end of the tunnel then?
So look, we're all acutely aware that the last several years we've seen a lot of restructuring costs, very weak profitability. We think we've defined a clear path to sustainable profitability for the company. And as we execute on that, I think it'll become more and more visible to investors and the market as a whole. So we're working to put this behind us as quickly as we can. You may have seen, and we'll talk about it more with investors today, 70% of the total transformation effects that we expect in this restructuring, we will have put behind us in 2019. So while, again, we're acutely aware that it's painful to post losses, we think we've made the right decisions, and we think we've moved very quickly to put the burdens of that restructuring behind us.
The idea of M&A, is that completely dead now?
Look, there's lots of sort of talk about consolidation in Europe in a recognition that scale and our competitive position relative to the US banks is an issue over time that we would need to address, and consolidation is an answer to that. I think you also hear from executives across the European banking sector that the preconditions may not yet have been established. So it's hard to judge the timing and the course that will take. But of course, it's a topic that management teams all across Europe will need to be thinking about sort of in the background.
You're only worth about a third of your share price, about a third of your book value right now. How do you see that progressing? I mean, does the book value come down? Do the shares get closer to that?
Look, we've managed a very conservative balance sheet through this restructuring, and I think that more and more is getting the attention of investors. So that part of our franchise is strong. What we need to demonstrate is this path to sustainable profitability, and with that path, and as it becomes more and more visible to the marketplace, we think that'll feed into our securities prices. You've seen it, obviously, in tightening CDS spreads and improving, not unsecured debt spreads, and also our AT1 instruments. We'd clearly like for that progress to continue, and as you say, at about 34% of tangible book, it's a valuation that one would argue does not yet fully reflect what we think we can achieve and what we've told the market we're committing to achieving over the next several years as we execute on this plan.